Hey guys, how's it going? So in today's video, I want to talk about my investment strategy for the year 2021. So in this video, I want to specifically talk about why you should consider investing in consumer discretionary stocks. Now specifically, I'm talking about Fidelity's MSCI ETF. It's called FDIS. So as the economy bounces back from the lows that we saw last year in 2020, I think it is a good idea to invest in companies that are operating in consumer discretionary sector. Now, if you're wondering what is consumer discretionary, it's a term used for classifying goods and services that are considered non-essential, but they are desirable by consumers. So think of stuff like cars or appliances or various miscellaneous entertainment goods and services that various companies offer. So in United States, MSCI index is designed to capture the large and mid-cap companies that operate in consumer discretionary space. Some prominent companies included in this index are Amazon, Tesla, and you have retailers like Home Depot, Lowe's, Target, and even fast food chains. So, one of the big hitters there is McDonald's. Now, these companies have consistently outperformed the market this year. And not just this year, but if you look at the last 5 years, performance, you will be surprised to find that all these companies which are operating in the consumer discretionary sector, they are actually outperforming S&P 500. So here is a chart comparing the returns from FDIS versus S&P 500 in the last 5 years. And as you can see, FDIS has delivered over 150% return compared to 96% that S&P 500 has delivered. So if you had purchased a typical S&P 500 index fund, you would have got around 96% return in the last 5 years, which is much less than what FDIS would have delivered. As the economy moves forward in the rest of 2021, I think the big retailers like Amazon, Home Depot, Lowe's, Target, and also these fast food chains, specifically McDonald's, I think they are going to do really well. So I have been putting my money in FDIS ETF. Now there are many consumer discretionary ETFs, but I like Fidelity's offering because it has a very low expense ratio of only 0.084%. So that means if you invest $10,000 in ETF, Fidelity is only going to charge you around $8 per year. So that's a very low fee for basically holding this ETF. Of course, you can always buy individual stocks that are listed. For example, here in the top 10 holding of this ETF, you see common stocks like Tesla and Amazon and Home Depot and other companies. And if you're wondering, hey, why can't I just buy these stocks as opposed to buying the ETF? The main reason I would not recommend buying individual stock is because you're exposing yourself to a lot more risk by buying individual stocks. Obviously, individual stocks are going to be more volatile. FDIS, on the other hand, it has 275 stocks and it provides you with much more diversification. So these companies are all operating in the consumer discretionary sector. You are not relegated to few stocks, and so you will not have risk exposure will be mitigated for you. Now FDIS ETF, it includes two heavy hitters. So you've got Amazon and you've got Tesla. So Amazon makes 22% of this ETF and Tesla is around 12%. So that's a large enough share to reap handsome rewards from the rapid growth that these two companies have been delivering quarter over quarter. But you are still controlling your risk exposure because you are not all in all these companies. You are actually invested in over 200 companies, and so you are basically going to see all the benefits, but you are still not going to be losing your shirt if suddenly these companies basically go down. Tesla's stock, by the way, has been very volatile, and so I will not really own Tesla stock directly, but I want to get a piece of the growth in that sector. So I always go for ETFs which have Tesla stock, but they also spread the risk over many other companies, so you are covered. Okay, so I wanted to study this FDIS ETF more, so I went ahead and pulled all the relevant data from Fidelity's website and I created this Excel sheet. So in this sheet, I am modeling how much money you would have made if you had invested $100 every month in this ETF since November 2013. So that's the last date data that I could get from Fidelity. So let's just go with this assumption. You invest $100 every month starting November of 2013, and how much money you would have made if you were doing this consistently, rain or shine, you were buying and you were holding. So this column shows you your principal amount, which will increase every month by $100 because you're buying this ETF $100 every month. And the second column shows how your money would have grown if you had invested this $100 every month in FDIS ETF. So to get a better picture, let's look at this chart. So this chart shows how your investment would have grown. The red curve in this chart shows the dollar value of your total investment, while the blue line is showing your principal amount. So as you can see, your total investment would have steadily grown over these years, And interestingly, it would have weathered the 2020 crash from COVID-19 lockdown, and it would have recovered very quickly. So your original investment of $100 every month would have grown to $17,883. So these returns are easily beating the average US stock market performance over the same period of time. So that basically means that instead of putting the $100 in this particular ETF, if you had invested it in a S&P 500 index fund, you would have ended up with less money. In fact, far less money. Here is a chart comparing the performance of FDIS versus S&P 500. As you can see, both the broader US stock market and FDIS ETF fell last year during the COVID-19 induced panic, but FDIS recovered far more quickly than the whole market. In fact, you would have ended with only $13,911 had you invested your money in S&P 500 as opposed to FDIS over this period of time. So that means FDIS would have outperformed any S&P 500 ETF by over 28.55%, which I think is pretty impressive. Now guys, obviously the past performance is no guarantee for future growth, but in my opinion, as COVID-19 restrictions are lifted, these consumer discretionary stocks, they are going to outperform the market and they will continue to do well. So I am putting my money where my mouth is, and this year I am buying FDIS ETFs. So guys, what are your thoughts on the consumer discretionary stocks? Are you bullish on the current US stock market, or do you think we are in a bubble? Let me know guys in the comment section below what your thoughts are. If you found this video useful, please like it and subscribe to Techno Panda Money for more videos like this. Also check out my main channel where I review laptops and other electronic gadgets. So if you are into, laptops, gaming laptops, PCs, how to build your PC, if you're into that kind of stuff, do check out my main channel. I think you will find that content very interesting. So again guys, thanks for watching this video, and I will see you guys in the next one. Bye.